The pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
So it is Saturday, and we are talking about money. And talking about money, are you one of those that's worried about running out of money? Do you have enough, but may believe that good is not good enough? You want great? Well, today's program is about both, and it's the same answer. And the question is, how do you know if you're getting good, great, or poor advice? I want to start with a study that's been done, and I've mentioned this study before, but just stay with me for a while. It's about money, it's about chance, and investing is never certain. And the study's been done. It started with a number of people. They were given $20, and they had to make 20 decisions on whether to bet or not bet. 20 times they could bet $1 or not bet at all. And each time you bet $1, it would be on a flip of a coin. Heads you win, tails you lose. Heads, if you won, you get $1.50 in profits. So if you put $1 down, and if it comes up heads, you get $2.50 back. If it comes up tails, they take away your dollar. So stay with me. I'm going to ask as if you're playing the game, and you can't see the coin I'm going to flip, but I'm going to tell you that I'm flipping a coin, and I'm going to tell you whether it comes down heads or tails. And you start with $20. You lay out $1. Let's get the game underway. So I'm flipping a coin, and it comes up heads. That's great, right? I give you back $2.50. So now in your little stack of money, you have $21.50. So will you play again? I assume you'll play again. You put another $1 down, and I'm going to flip the coin, and that's heads again. So I pay you back $2.50, and now in your stack, you have $23. Going to play again? Probably so. So you put down another $1, and I'm going to flip the coin. Here we go. Here we go. It's coming down. It's tails. You lost your $1. So now your stack is down to $22. Still a couple dollars more than you started with. So you'll probably play again, right? Or will you quit? You're ahead by 10%. You're ahead $2. Started with 20. Will you quit just with 22? Maybe not. Suppose you play again. You put down another $1. I'm going to flip the coin. Here we come. It's tails again. I'm going to take away the $1. So now you have only $21. Started with 20. You won a couple times, lost a couple times. You're ahead $1. Will you stop? Well, maybe not. Maybe you'll play one more time. The worst that can happen is break even, right? So you put down the $1, and I'm going to flip the coin. Here it comes. It's tails again. I take away your $1. Now you're back to what you started with. Don't bet anymore. I'm going to bet again. Well, maybe. So you put down another $1. I'll flip the coin. Here it comes. Tails. You lost again. I take the $1, and now you're down to 19. You've lost money. So that was the experiment. Only you could play up to 20 times. And it's in the best interest of everyone to play all the way, to continue to play 20 full times. Bet $1 each time, whether you're ahead or behind. Best interest is to continue to play. If you continue to play and it's 10 heads and 10 tails, no matter what the sequence, you're going to end up with $25. But it doesn't often happen that you always get 10 heads and 10 tails. Sometimes you get more tails. Sometimes you get more heads. So it's not always a 50-50 deal. So let's go back to the game we were playing. You're down to $19. If you continue to play for the rest of the time, and it's half heads and half tails, you walk away with $22.50, starting with 19. If, and that's because we started with 2 heads and then 4 tails. If you play the entire game, if you start as we did at the beginning and play the entire time, all 20 plays, 87% of the time you end up with more than $20. Only 13% of the time do you lose money. You know, that's if you make it that way in our game, where you started with 19, you end up with 22 and a half, and 76% of the time you end up with over $20, starting with 19. But with a normal group, what they found in this study when they did that is less than 40% would continue betting if they got a tail. Less than 40% would continue betting if they got a tail when they lost. And it got worse when time went on. 70% played on and off for at least the first 5 rounds. Sometimes, some would play all 5 rounds. Some would play 1 and then drop out, play another couple, then drop out. But at the end of the game, fewer than 40% made it every time. Fewer than 40%. It's like that. Fear causes investors to shy away from bargains. You know, when the market is really down, it's like the stocks are on sale. But you know what? People feel a lot better about betting when they're ahead. If we would come up with 6 heads in a row and you were ahead by quite a bit, you'd probably continue to play and feel really good. It'd be better. You'd feel much better off playing when you're ahead. But if you had 6 tails in a row, even if you knew almost for sure that there would be heads coming up, you almost for sure shy away from betting. You know, today we're looking at a time as we come forward. We've been through a pandemic. We've been through a great recession. There's a lot of things to worry about. Pandemics, COVID-19, a GDP that sank, record unemployment, record GDP loss, elections, police brutality, looting, protesting, Black Lives Matter. There's the question of the U.S. debt. There's a question of small businesses going out of business. There's a question of what's going on in Russia and China and the rest of the world. There's a question of the terrorist. There's people that are losing health care, that lost health care because of COVID-19. We have all these questions about climate change, about income equality, and all these things to worry about. So it's normal for a large majority of investors to worry that they're going to lose money. And financial advisors and brokerage houses all know that. And if you had a financial advisor who had your best interest in mind, in that game that we just went through, the $20 20 times, wouldn't your financial advisor say, look, the chances are 87% you're going to make money. Only 13% of a chance are you going to lose. Isn't it in your best interest to play the game all the way? Wouldn't that's what a financial advisor say? If he's worried about your best interest, you know, that's probably not the advice you're receiving. The big firms now and financial advisors now are using something called behavioral investing. It's the latest buzzword in the world, my financial world. Behavioral investing. It's not to maximize your investments. It's to make you feel good. That's it. behavioral investing is to make you feel good. You know, our normal minimum is 100,000. So let me put things into terms of 100,000. The idea is if you make 5%, and if you ask your financial advisor, most are saying you should expect 5%. You should be happy with 5%. And some of the ones at the extreme are saying 8%, but somewhere between 5 and 8%. Aren't they saying that? What does that mean? 5% over 10 years grows that 100,000 into 156,000. If it's 10%, it's 235,000. If the difference between 5% and 10% is 8,000 a year, plus 1,000 in fees, you're giving that away. You're giving it away. 10 years at 20, think about it. If at the end of 10 years there's a 20% bear market and you have 10% protection, you end up with 10% at 188 versus 140 at the lower rate. So we're going to come back and talk about this whole thing after this commercial break, because we are coming to a commercial break. There's a lot more to talk about. There's a lot of this behavioral investing that's taking place. It makes you feel good, or it's supposed to make you feel good at the current time. But is it really in your best interest? Will you feel good at the end of your life? Let's stay with me. We'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I want to take you back to September 1951. It's the second year of the Korean War. And there's a Korean junk filled with a mess of bodies. 19 young boys, bloody, bleeding heads, bleeding arms, broken legs. They were caught in an ambush during the war. And that boat pulled up alongside the Royal Canadian Navy ship Cayuga. And there's a Dr. Joseph Sear, a surgeon lieutenant, pulls out his medical kit, and he prepares to go to work. There's only one problem. Dr. Sear did not hold a medical degree. In fact, he never even graduated from high school. But nevertheless, he went to work, and for the next 48 hours, he performed surgery after surgery after surgery on all 19 of those young men, and each and every one would have died without him, and every single one survived. Not only was he not qualified, the only thing he had was a medical textbook that he had borrowed from a real doctor. He saved the 19 lives that day, and that made its way into the press. And that was when they discovered the real name was not Sear. His real name was Ferdinand Waldo Damara. He had previously impersonated and sold himself as a professor, as a psychologist, as a monk, as a founder of a religious college, and many, many more functions. He would become known and became very famous as the Great Imposter. All that from a book by Maria Konnikova called The Confidence Game. Says it's one of the oldest stories ever. It's the story of belief. It's basic, irresistible, universal human need to believe in something that reaffirms our belief. Konnikova points out, and I want to quote this, quote, "In some ways, confident artists like Damara have it easy. We've done most of the work for them. We want to believe in what they're telling us. Their genius lies in figuring out what precisely it is that we want and how they can present themselves as the perfect vehicle for delivering that desire. Let me paraphrase it again. The confidence artist, like Damara and some of the other con people, they have it really easy because you and I do most of the work for them. We're susceptible to their scams because we want to believe in what they tell us. They're geniuses at figuring out what it is precisely that we want. And then they figure out how they can present themselves as the perfect vehicle to deliver on what we want. I spent 18 years working for big brokerage houses, and their instructions and marketing were to sell the relationship, not the performance. Let me say that again. Sell the relationship, not the performance. There's a reason they don't publish the results. They know that you and I do not like to lose money. It's back to the game, flipping that coin. You lose a couple times, you quit investing. They don't want you to quit investing. Asset allocation is set up to protect against losses. What they don't tell you is you're going to have less money in 10 or 20 or 30 years. They figured out that you don't like to lose money, no one does, and they sell you the whole idea that this is a safer way to invest. And not only that, they've sold this whole idea to the regulators as well. Every time we talk about returns, we have to say past performance is no guarantee of future performance. But is it really true? How do you explain the Warren Buffetts, the Roe Prices, the John Templetons, the Peter Lynches? Those were investment managers who were, when they were investing, they delivered higher returns over long periods of time. Eugene Fama, out of the University of Chicago, shared the Nobel Prize in 2013 in showing that 7% of money managers, 7% of money managers earn their fees when you consider what they're doing compared to their benchmark. 93% of money managers do worse when you take into consideration their fees. They found that only 3% perform 1% or better. You know, some money managers have very short runs. Standard & Poor's did a study of mutual fund managers, and they found that 30% for a period of 3 years outperformed their benchmark. But only 10% do that for 4 years. And if you carry that out to 10 years, 5% outperform on the average over 10 years. So it drops off from 30% for the first 3 years to 10% in the fourth year, and then it declines slowly to 5% at the end of 10 years. You know, some have short runs, and in a short time, who can say it? In the short run, and Morningstar's done the work as well, saying for 3 years, past performance is really no guarantee of future returns. But you have people like Buffett and Price and Templeton and Lynch's who've done it for multiple years. So have I. But that's another point. How do you explain my returns? Skill and luck? So sometimes I like to explain it in terms of games. If you look at the game of chess, experts always win. Novices never beat a chess master. Chess masters always win. If you look at slot machines, it doesn't make a bit of difference between the winning percentages between novices and experts. They're always the same. But in the game of poker, poker is a game of both skill and luck. And sometimes novices beat experts just based on luck. It's skill that wins out over the long term. It's luck that can win out over the short term. To me, it's a lot like investing, and you can see that in my returns. I posted my returns for the growth account, looking at accounts that begin at 100,000. In the last 11 years, from the time of 11 and a quarter years, $100,000 invested at the bottom of the market would have grown to 646,000. That's an average return of 18.05% per year compounded. That compares to the Standard & Poor's total return of 15.2. Remember, Pharma showed that fewer than 7%, considering fees, can equal that 15.2%. And fewer than 1% or 2% can do the 18%. Numbers-wise, that works out in 11 and a quarter years to 646,000 for my average client versus 491,000 for the Standard & Poor's 500 with the dividends reinvested. In my opinion, that mostly demonstrates skill with not a huge amount of luck. Now, that's the growth account. The profit sharing account, if you look at that, and the regulators only recently allowed that in the last couple of years, I just started that and have my first accounts going now. It's a short term, but that account in less than 5 months has roared ahead 103%. $1 million, which is the minimum, $1 million at the end of July stood at $2,033,000. And as of this time, it's close to $2.3 million. That same period of time, the Standard & Poor's 500 with dividends reinvested went from $1 million to $1,110,000. That's 103% compared to 11%. Yes, there's some skill. There's some skill in picking the stocks, but there's also mostly luck. I admit that. Over the longer term, it's not going to be 100% return in 4 months or 5 months. Over the longer term, it's probably going to beat the 18%, but it is not what we've seen in 5 months. Most of that is luck. I picked stocks back in the last part of last year that happened to truly, truly benefit by the pandemic. I didn't know the pandemic was going to hit last year, but truly, it's accelerated the performance in that profit sharing account. Mostly luck, but a little skill. That's the difference between what's going on between my clients and the regular clients of most financial advisors. My clients understand there's a reason to have strong performance, and they can afford to take a 10 or 15% hit. Would you rather have a 20% hit on 646 or a 10% hit on 491? 20% on 496 still leaves you 550,000 versus 450,000 on the Standard & Poor's. So it's skill and luck. And I believe that during the longer term, it is, in fact, a question of skill. One of the classic books I'm going to talk about when we come back to the next session, I want to talk about Random Walk Down Wall Street. Stay with me. We got to talk about that.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So one of the classic books for financial advisors, for investors, it really set a new trend. It was a book by Burton McKeel, who wrote a book called A Random Walk Down Wall Street. And what he said is returns in the stock market are completely random. You can't expect to beat the market because things are so random. You can't predict whether it's going to be up, down, or all around. It just is impossible to beat. So that was back in 1987 when I read that book. I had licensed in 1986, in June of 1986, and I read the book. And I had to call him. I actually called him and talked to him. And I asked him, if the market is so randomized, and if no one beats it, how do you explain a Warren Buffett and a Roe Price and a John Templeton and a Peter Lynch? And his response was, well, some do beat the market, but it's few and far between. He said, most people, 99.9%, 99.99% do not beat the market. It's very random. It's very low. So for the most part, people should just consider that it's a random walk down Wall Street and expect to have a return less than the market. He wasn't the only one that wrote books like that. There were a number of people in the 90s that wrote books like, you should expect less than the market. Even professional money managers underperform over the long term. So an individual should not expect to perform. Just like Dr. Sear or Damara, financial advisors and their firms have figured out precisely what it is that you, the investor, want. And it's like the game. They know that, and they want you to believe that every financial advisor is the same when it comes to investments. They want you to believe that what a computer spits out is the best you can do. They want you to believe they figured out that financial plans give you security, and they give you a plan which you believe in and you can depend upon for the rest of your life. And not only that, the financial plan will have every color under the sun in it. It'll do pie charts and graphs, and it will do Monte Carlo simulation to give you all the probabilities that you're going to make it. And it makes 91% of investors feel very confident. Feel very confident in their plan, feel really good and value their financial advisor, and they end up feeling that everything is good in the world. Still may be a little worried that they're running out of money. Still may be worried that they might have enough to retire upon. But what the financial advisors and the big firms don't tell you, and I'm not sure how many financial advisors understand it. I got my undergraduate degree in math. I understand the math. I understand that Monte Carlo simulation doesn't work in reality. The thousands of investors who believed their plans got completely shocked in the Great Recession when what was supposed to be safer and less volatile left them short. Some children didn't have enough to go to the college they had selected. Some retirees had to go back to work. Some pre-retirees had to work longer than they planned. And some pre-retirees had to reduce their expenses. Some retirees had to reduce their expenses. I would guess that you, the listener, has a financial plan. Did your financial advisor tell you that the financial plans don't always work? We listen to ads on the radio that say, this is a medication that is for heart disease or for whatever it might be. And they say the side effects are. Does your financial advisor say, these are the plans we have for you, but the side effects are, they may not be right, they may not work when, they may not work how? No. They follow up by telling you this is what you should expect. Does your financial advisor even know how well they work? Do they even know that simple math is such that you cannot maximize returns without asset allocation? Great Recession taught us, the pandemic is teaching us that asset allocation doesn't really protect us. But from a spin perspective, it's the perfect It's the perfect story. They figured out what you want to hear. They figured out what will make you feel good. And you, the investor, has done all the work for them. They show you that that's the perfect place for your money. Listen again to the quote from Konnikova. She described con men this way, and I quote, "In some ways, confidence artists like Damara have it easy. We've done most of the work for them. We want to believe in what they're telling us. Their genius lies in figuring out precisely what it is we want and how they can present themselves as the perfect vehicle for delivering that desire." All of that really bothers me because at Adams Financial Concepts, we only do three things. We specialize in what we do, and if we don't do a certain aspect of financial services, we refer it to the very best in the field as experts. So we do three things. We do 401ks. And we do the 401ks, we focus on the return on investment achieved by the investors in the 401k, by the participants, by the employees, by the employer. We focus on the return on investment. We focus on preparing the employees for retirement. We give them an outlook. Right now, the Department of Labor is talking about requiring that 401k providers show what a person in a 401k can be expected to have at the time of retirement. We've been doing that from the beginning. We do a complete 20-plus page report every year for every single participant in our 401k. And every quarter we do a 3 or 4 page summary. And we say, this is how you are doing. This is where you will be when you retire. Do you have enough? What do you need to do? And we also counsel on changing their investments. We're not in the business of going into 401k retiree and talking to the employees about how they can do insurance, how they can do health savings accounts, how they can do all sorts of other things, how they can invest their money outside the 401k. We're only interested in seeing that they're prepared for retirement. And we're only interested in seeing that the employer benefits. And we're interested in seeing there's a return on investment from the 401k for the employer. It's profitable for the employee, it's profitable for the employer, and of course it's profitable for us too. The second thing we do is for individuals with $100,000 to $999,000, or individuals that don't have a net worth of $2.1 million, we do with portfolio. My passion is to create wealth. I want to see people grow. If you ask a normal financial advisor and they tell you to expect 5% or 6% or 7 or 8, I'm not very happy with that. And I don't think my clients are very happy with it. But my returns, 646 versus 491 for the Standard & Poor's over 11 and a quarter years. And legally, when I talk about my performance, I always have to say past performance is no guarantee of future results. That's a legal requirement, and I do say it. But 93% of money managers do not even get to even at 491. So what does your advisor say? Expect 5% over that same period of time. Instead of 646, at 5%, you would be at 171,000. Or an aggressive financial advisor at 8%, 233,000. That's a third of what the composite of my clients are doing at 8%. And it's a quarter, well, a little over a quarter of what my clients are doing at when you're doing 3. Is that really in your best interest? Is it truly in your best interest? My clients can absorb a 30% drop in the market. Can you? And there's a reason why financial advisors do not publish. And we publish our results. You can go to the website. You can look at how my clients are doing on the average, net of all fees and costs. You can look both at the regular growth accounts, and you can look at the profit sharing incentive account. But there's a reason why most financial advisors don't publish. And if they really did perform well, don't you think they'd show it? Sure they would. You know them. If they beat the market, they would publish it. The third thing they do, of course, is for the accredited investors, those with $1 million or more in the account and a net worth of 2.1 excluding home. We do the long short, 150% long, 70% short, net exposure 80%, best volatile, and higher performance. And if I could, I would do it for everyone. Regulators limit it to 1 million, 2.1. So stay with me. I want to come back and talk about safe money to finish this. Don't go away. Be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So sometimes some beliefs about the market are really myths. One of those is that volatility equals risk. When accounts go down, that's considered risk. Volatility equals risk. Well, the answer to that is really yes and no. And I took information from a book by Markham, Hazardous to Your Wealth, Extraordinary Popular Delusions and Madness of Mutual Fund Experts. It's patterned after a book written by McKay in the 1850s about extraordinary popular delusions and madness of the crowds. But this time he says madness of the mutual fund experts. And he talks about some of these myths. And this is one of the more common myths, is that volatility equals risk. More volatile an account is, the more risky it is. And considering that we've been through a Great Recession, a pandemic, the belief is that a T-bill portfolio is safer and more conservative than a stock portfolio. But really, it depends upon the type of risk, and it depends upon the time horizon. Credit risk, or risk of losing everything, yes, T-bills are safer in that respect than stocks. But on a time horizon, in my opinion, the time horizon counts more than the immediate risk. So let me give you two hypothetical portfolios, one that's both starting with $100,000, both for a period of 25 years. One invested in T-bills, one in the average of the stock market, or not even the average of the stock market. Let's just take 9%. And let's take a T-bill that's rolled every 3 months, and it's paying 3%. Now, today, it's less than 1/8%. But just assume we get 3%, which is over a longer period of time, what we've seen is 2 to 3%. So just take 3%. Over 25 years, that $100,000 is going to grow to $222,130. And it's safe on the bottom side because it's not going to go away. It's the full faith and credit of the U.S. government. So you get a lot of safety on that. $222,000. Making money seems pretty good. $100,000 invested. 25 years later, $222,000. Stock market, on the other hand, just take 9%. There's a lot of questions as to whether the stock market return should be 6%, 9%, or closer to 12%. It's been 12%. Well, we've been doing 18 for my clients. It's been not 12%, 15%, I'm sorry. But let's just take 9%. That 100,000 would have grown from 100 to 862,000. Not 222, 862,000. Even if you add inflation, if we have 3% inflation, the T-bill portfolio is back to 100,000 of purchasing power. And if the T-bills are paying 0.1%, T-bill portfolio is actually, in terms of purchasing power, going to lose money, whereas the stock market, even at 3%, is going to be significantly better. It's going to be, even at 9%, almost 450,000. So, depends upon your definition of risk and what risk is. It's a time horizon. So that brings me to the second point, is safe money. It's a big point for most financial advisors. It's a big thing when you're going through an interview with financial advisors, or when you're talking to your financial advisors, they talk about safe money. And listen again, I've used Konnikova a number of times, and let me read it again one more time. In some ways, confidence artists like Damara have it easy. We've done most of the work for them. We want to believe in what they're telling us. Their genius lies in figuring out precisely what we want and how they can present themselves as a perfect vehicle for delivering that. I talk about it a lot of times, and I'm going to continue to talk about it because it's so important. You've heard the ads, I'd rather die than do an annuity. You know, I don't do annuities, and I believe that very, very few people should have annuities, but I believe it's one of those things that are sold as safe money. And once again, I come back to Helen Owen, who wrote Pound It Foolish, Exposing the Dark Side of the Finance Industry. And she wrote a lot about annuities. She said there's two things to know about annuities. The first is they're increasingly sold to baby boomers worried about running out of money. Let me amplify that. Going through a Great Recession or a pandemic, there are concerns that we're not going to have enough money when we retire, or even if we're in retirement, we're going to run out of money. So that's already makes you a target, and you want to hear what they have to say. The second thing is that they're so complicated, so difficult to understand, so many financial penalties. They are structured so that you don't understand. Even Susie Orman, who is not one of my favorites, and I don't agree with most of what she says, and many other experts recommend against annuities. But annuities are sold for one and only one reason, according to Helen Owen, and I agree with that. Annuities are sold for one and only one reason, and that's to make money for financial advisors. Rarely is it in the best interest of the client. And yes, there are some, but there are very few clients in whom the best interest is to do an annuity. They're always sold in the same way. There's no such thing as a free lunch. Just isn't a free lunch. They tell you it's a free lunch. They invite you, you sit down at the lunch, and during that lunch, it's all considered. We're all done the same way during those lunch. Or actually, let me backtrack a second. Both the SEC and FINRA said that over 1/2 of the filers are misleading. The fact they say there's low risk is misleading. That's regulators saying that. They're based on creating fear. And yet 9% of attendees will actually buy the annuity. There's a pattern, and it's always the same. It's use fear, make them sweat a little, pose a problem. At the same time, the annuity is the solution, but don't use the word annuity. Press the hot button. Will your retirement survive the economic meltdown? Facing in retirement, do 20 slides or 20 more slides. Say that Social Security is uncertain, taxes could be up to 85%, health costs are increasing, 47% of Americans will run out of funds if they retire at the age of 65. Are you part of the 47? You have nothing to fear if you plan for it, and an annuity is the way to plan for it. Now, advisors get paid up to 14% of what you put in. More commonly 6 to 8%, but some up to 14%. And your returns in the annuity are not very good. Whether it's fixed, whether it's variable, you're going to underperform all the way around. And those guarantees, the guarantees are based on something that will pay you over a longer period of time. There have been annuity companies that have gone out of business. There will continue to be ones. So whatever you do, don't buy an annuity. It's not safe money. It's going to leave you behind. That wraps up today. Join me next week when we will again be talking about money. And have a very good week and weekend.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial.